Well, for some thoughts on what's moving international markets, we speak to Michelle Schneider, Chief Strategist at marketgauge. Mish, good morning. Thanks so much for joining us today. Let's start off with U.S. retail sales, which came out overnight and did beat expectations, rising 0.7% in the latest month. What is your view on the latest retail sales data? What does it say about the strength of the U.S. consumer?
Well, it was up more than expected today, but it's actually been strong over the last 3 months. And it's been the consumer really over the last couple of years, in spite of everything, that has kept the economy going, and was happy to see that that's still the case. There was a little bit of a shift in terms of some of the spending habits. There was a gain in auto sales, which was something that was really down for the first part of the year. Now that actually led the retail sales higher, where food and services, which has been classically strong, was actually down. And then the other case of rise was in the online shopping. So it seems that right now the consumer seems to be completely unfazed by any potential headwinds in terms of keeping money in their pocket.
What could change those dynamics in 2025? When do you think the consumer will start feeling less resilient?
Well, right now it's hard to really fathom, but we can certainly make the case. People are making money in cryptocurrencies. They're making money in equities. There's been a tremendous drive out of bonds into both stocks and cryptocurrencies. And so people are feeling good about it. So what would make that change would be a couple of things. Number one is if some of the policies that I think people are drawing a lot of optimism from the new administration do not necessarily come to pass, or they're not as effective as people would think. Like, for example, being able to lower the corporate rates for taxes to 15%. Companies that deal in the United States may not be so easy to discern that and get that done. May not be so easy to get tax cuts even for people. In terms of deregulation, it could certainly derail if it turns out that actually it becomes more chaotic, with a lack of accountability, if you will, in certain areas that the government is necessary in. Geopolitics is certainly something that could always rear its head. We've seen it come and go over the last several years. Things are sort of bubbling. Luckily, right now, they're not boiling, but that could happen. And then, good old weather problems. I mean, there's a lot of predictions for a lot more earthquakes, tsunamis, hurricanes, fires, etc., which of course would then affect supply chain, which of course then affects inflation. And so I think if we have a rise in inflation, really to sum that up, and we don't see interest rates go much lower, at some point the consumer could become disappointed. But for right now, that seems to be on the shelf.
So let's talk about this interest rate direction. What's your rate outlook then for 2025? I think the 25 basis points is already priced in for the last FOMC meeting for the year. But for next year, what do you think the Fed is going to do?
Well, everybody believes that they're going to lower the rates tomorrow, 25 basis points, and that's probably the case. And of course, everybody's going to be listening keenly on what Powell says for the next year, and particularly in January, which many people see he'll just sort of pause. But, it's interesting. If you look at the long bonds and the yields right now, they have been in a downward trajectory, in that the yields have gone up and the long bonds have gone down, really since they peaked in 2022. And so it's really going to be a matter of what would make the Fed have to actually get more dovish. So I don't think they're going to get much more dovish. I just don't think they're going to be much more hawkish unless they have to. And of course, what would make them much more dovish would be if the things we just talked about in terms of the plans to really stimulate the economy beyond the consumer don't necessarily work out. And now we have a flight to safety into bonds, and the Fed has to cut to stimulate the economy. That would be the seed change. But for right now, I kind of look at rates staying relatively steady, maybe somewhere, if we're really generous, between 3.5 and 4.5, just basically where it's been now over the last year.
Can I ask you about US markets? I mean, they have really done extremely well. Look at NASDAQ, up 34%, S&P 500 up 27%. Is 2025 going to be another year of US exceptionalism?
Well, certainly we hope so, right? But again, I mean, in terms of what happens next year, what has been a little bit disconcerting in the last week has been the fact that you have the S&P 500 and the NASDAQ still moving higher while you've seen the equally weighted S&P or the RSP and the small caps fall along with the Dow Jones Industrial. So in order for it to have American exceptionalism, we need to see that broadening out. And again, that's going to be very much dependent on what can we get policies to really work, how much of what he's promising Trump will come to fruition, what's going to happen with the rates, are they going to not go up at least, or at least stay here or go down a little. And then of course things like tariffs and employment, which has shown signs of a little bit of the labor market weakening. So this is all what we're keeping an eye on. But right now, if you just took all of that out of your head and you just look strictly at the charts, you're looking at a lot of these areas that are related to American exceptionalism, oversold and undervalued, which mean there is that potential for a whole broadening of the U.S. economy and the market next year.
So what sectors would you be overweight on for 2025, Mish?
Well, there's a few things. I've been very keen on the whole idea of the expansion from the diet drugs into the thin consumer. So healthcare would be a part of that, in that people are going to be looking at not only taking the diet drugs, but taking supplements and feeling better about themselves, maybe taking better care of themselves in terms of going to doctors and having more elective type procedures. So that whole area will be good. And then that trickles into skincare and beauty, and then diet in terms of getting out and exercising, and maybe even gets a little bit into the dating world. So that's really all those stocks that are related to that I'm very keen on. I think real estate has a good chance of doing very well next year. I still think AI has a lot more upside, but it may shift from the hardware side to the software side. So you're looking at companies like Google, which has done so well, and Salesforce, a couple of others that are more the software oriented. And I'm still very, very, very bullish on gold.
Interesting, because it hasn't been doing well, right, the past few months relative to its other asset classes.
Yes, that is true. But then let's define not doing well. We're still trading above 2,600, considering where we started the year. That's a huge gain. So I look at gold more as taking a rest, taking a breather. A lot of the money that people were doing to speculate in gold, of course, we know has gone into Bitcoin and some of the other cryptos. But I do believe that this 2,600 level is huge support. The fact that it hasn't broken down, considering right now that people aren't particularly afraid of anything, tells you that there's still a lot of underlying buying there from central banks in China. And if we can stay here at this over 2,600, get back over 2,700 or even 2,750, I think, here comes 3,000. And then you'd have to ask yourself why.
Mish, thank you so much for speaking with us. That was Mish Schneider, Chief Strategist at MarketGauge, giving us her take on some of the trends that she sees moving markets in the days and weeks ahead.